There is a notice the IRS sends to retirees at age 66. It does not say IRS on the envelope. It does not say urgent. It does not look like anything important. And most people, maybe 9 out of 10, fold it up, set it on the counter, and throw it away within a week. And that single decision costs them hundreds, sometimes thousands of dollars every single year for the rest of their retirement. I am going to tell you exactly what that notice is, what it means in plain English, and what happens to your bank account if you ignore it. Stay with me all the way through, because at the end I am going to show you a strategy that can reduce or completely eliminate the extra charge this notice is trying to warn you about. This video is for educational purposes only and is not tax or financial advice. Please consult a qualified tax professional before making any decisions about your specific situation. My name is Kevin. This is Kevin Reveals. Every week I break down the IRS rules, the tax traps, and the financial strategies that protect retirees from the things nobody is explaining to them. If that sounds like something you need, hit subscribe right now and turn on the bell so you never miss a video. Let us talk about what this notice actually is. When you turn 65 and you enroll in Medicare, you get the standard Medicare Part B premium. In 2026, that standard premium is $185 a month. Most people know that. Most people plan for that. They budget around it. They set up their Social Security direct deposit and they assume that number is fixed. It is not fixed for everyone. The IRS sends your income information to the Social Security Administration every single year, and the Social Security Administration uses that income data to calculate something called IRMAA. That stands for Income-Related Monthly Adjustment Amount. And what it does is this. If your income crosses a certain line, the government charges you more for Medicare. Not a little more. Sometimes a lot more. And the notice they send you in the mail is the letter telling you that you have crossed that line and your Medicare premium is going up. Many retirees first learn about IRMAA only after they get a letter from Social Security saying their Medicare premiums will increase, often long after the income that caused it was already spent. That is the letter most people are throwing away. That is the notice they are folding up and setting on the counter, because it comes from the Social Security Administration, not the IRS. The envelope looks routine, the language inside is confusing, and most people have no idea what IRF even means. Here is why it hits hardest at age 66. You spent your whole career building up retirement savings. You hit 65, you retire, and maybe that first year you have a lot of income. You took a large IRF withdrawal. You sold some investments. You did a Roth conversion. Maybe you sold a home. You had a good income year right as you were crossing into retirement. Here is the trap. The Social Security Administration determines who pays IRMAA based on the income reported 2 years prior. So for 2026, the SSA looks at your 2024 tax return to decide if you must pay an IRMAA surcharge. So the income decisions you made in 2024 are showing up as a higher Medicare bill right now in 2026. You already spent that money. You already paid the federal taxes on it. And now a bill is arriving in the mail that you did not see coming. That is the hidden notice. That is the letter at age 66 or 67 that most people read once, feel confused, assume it is some kind of Medicare bookkeeping issue, and toss. Let me show you what that actually costs. The general IRMAA surcharge is calculated in tiers. In 2026, if your income crosses the first threshold as a single filer at around $109,000, Derma IRMAA surcharge adds roughly $70 a month to your Part B premium on top of the base cost. That is $840 a year. For a married couple, both paying IRMAA, that is $1,680 a year. And as your income goes higher, the tiers get steeper. At the highest income tiers, the Derma surcharge can add over $300 a month per person to your Medicare cost. That is $3,600 a year per person, on top of your base premium. And here's the part that makes this even more painful. A single retiree with income at the bottom of a higher bracket pays the same surcharge as someone earning much more within the same tier. $1 of extra income can push you into the next tier, and that $1 could cost you $600 or $800 more per year in Medicare premiums, not because of a tax, not because of a penalty, because of a surcharge bracket you did not know you were sitting right next to. This is what catches the most retirees off guard. Ordinary financial moves like selling a property, converting to a Roth IRA, or withdrawing from a retirement account can push you into a higher IRMAA bracket without any warning. That is the trap that catches the most retirees. They make a perfectly legal, perfectly reasonable financial decision, and it creates a Medicare surcharge 2 years later that nobody warned them about. Let me walk through what that looks like in real life. Take a retired couple. Both are 66. He has a pension of $60,000. She collects Social Security at $24,000. Their combined income is $84,000. No IRMAA, they pay the standard premium, everything is fine. Then in 2024, they decide to do a Roth conversion. They move $50,000 from a traditional IRA to a Roth. It makes complete financial sense. They're in a lower tax bracket, they want tax-free income later, they do the conversion. Their 2024 income now shows $134,000 total. 2 years later, in 2026, the notice arrives. Their Medicare premiums just went up. Both of them. Because their 2024 income crossed the IRMAA threshold. They are now paying $840 extra per person per year. That is $1,680 walking out the door because of one good financial decision they made 2 years ago that nobody told them would have this consequence. Your 2026 IRMAA is based on your 2024 income. Your 2027 IRMAA will be based on your 2025 income. Changes you make in one tax year show up in your Medicare premiums 2 years later. This 2-year look back is the engine behind almost every IRMAA surprise. Now, what can you do about it? First, you need to know the notice is coming before it arrives. If your income was higher 2 years ago than it normally is, expect an IRMAA notice. Do not throw it away. Open it, read it, because you have rights under this process that most people never use. If you disagree with an IRMAA notice you have received, you can appeal it. Reasons include incorrect tax information used by the SSA, outdated income data, or a life-changing event such as a loss of income, death of a spouse, marriage, or divorce. You have 60 days from receiving the notice to file an appeal. 60 days? That is your window. If you miss it, you pay the surcharge. If you open the letter, read it, and act within 60 days, you may be able to have your IRMAA recalculated based on your current income instead of the income from 2 years ago. The form you use is called SSA 44. It is the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event form. You fill it out, you document the life-changing event, and you submit it. It does not guarantee the surcharge goes away, but it opens the door to a recalculation that could save you hundreds of dollars a year. Second, if you're still in the planning phase before you hit 65 or in your early years of Medicare, there are strategies that reduce the IRMAA impact going forward. A balanced Roth conversion strategy can help reduce future required minimum distributions, even if it temporarily increases IRMAA for 1 year. Money from Roth accounts, life insurance cash values, or brokerage accounts can help manage your taxable income in Medicare years. Third, retirees age 70 and a half or older can transfer up to the annual limit directly from a traditional IRA to a qualified charity. This qualified charitable distribution satisfies your RMD without adding to your MAGI. That matters because MAGI is what IRMAA is calculated on. Lower MAGI means lower IRMAA. A QCD is one of the cleanest tools available to retirees who are charitably inclined and also trying to manage Medicare costs. Fourth, avoid bunching large capital gains like selling appreciated investments or a home above the exclusion into a single tax year. Spreading gains across multiple years can keep you below IRMAA cliffs. And fifth, know that Roth conversions are powerful, but they need to be timed. Qualified Roth withdrawals do not increase MAGI, but Roth conversions do. That distinction matters enormously for IRMAA planning. Converting counts against you. Withdrawing from an already converted Roth does not. Now let me talk about what changed in 2026 that makes this year different. A new $6,000 senior bonus deduction may help retirees reduce their federal taxable income. That is real, and it is meaningful for federal income taxes. But here is the nuance most people miss. The senior bonus is a deduction that reduces taxable income, not what the IRS considers to be your AGI. And IRMAA is calculated on your MAGI, not your taxable income. So while the $6,000 senior bonus helps your federal tax bill, it does not directly lower the income number Social Security uses to set your Medicare premium. That is not a reason to dismiss the deduction. It is still valuable. But it means you cannot count on the senior bonus alone to push you below an IRMAA bracket. You need to manage your MAGI directly, using Roth accounts, QCDs, and income timing strategies. Here's what this all comes down to. The notice that arrives at your door around age 66 is not junk mail. It is not a Medicare brochure. It is the Social Security Administration telling you that your income 2 years ago put you into a higher Medicare cost tier and your monthly premium is going up. Most people throw it away because the envelope does not look urgent. Most people do not know they have 60 days to appeal. Most people do not know what IRMAA is until it has already been deducted from their Social Security check for months. Now you know. Open the letter. Read the income year they used to calculate it. If that year was unusual because of a Roth conversion, a home sale, or a large distribution, file the SSA 44 and request a recalculation based on your current income. And going forward, plan your income each year with your MAGI and IRMAA thresholds in mind, not just your federal tax bracket. The difference between ignoring this notice and acting on it can be $1,000 or more every single year for the rest of your retirement. That adds up fast. Over 15 years, that is $15,000 or more in Medicare surcharges that you could have reduced or eliminated entirely if someone had just told you to open the envelope. Now that you know what the hidden notice is, the next question is whether you are filing your taxes in the most efficient way possible as a retiree. Because the IRS created a special filing option specifically for people over 65 that most people have never used, and it comes with a built-in advantage on your standard deduction. I break that down in the next video right here on Kevin Reveals. Watch it next. I will see you there.